Hi, it's John Musso. I am the CEO of Cumberland Advisors. It is Friday afternoon on September 27th. This is the bond report as well as the equity report. I am covering for my colleague Matt McAleer. As you know, we have suffered through Hurricane Helene here in Sarasota, but we got off lucky. The storm stayed out in the Gulf, did cause damage from storm surge. We did have loss of electricity in a lot of places, including our office building. We are working remotely today. And, you know, a lot of rain, but certainly not the damage that we saw as you went further north into Florida, and particularly as you got up to the Panhandle and Tallahassee and Big Bend, who caught the storm much worse. Of course, our condolences go out to all people who either got injured or in terrible lost loved ones in this storm, because it was a very damaging storm. And the hurricane season is not over yet, so we're watching it. Matt is north of here. He is in good shape. The bridges on both sides of his homes are shut down, so he is there with food, liquor, and recently got power, so he is in good shape. This week, saw the equity markets, you know, do okay. S&P up about 0.2%, NASDAQ up almost 1%. Couple of things behind that. Number one, we saw continued, basically fiscal stimulus into the Chinese market by the Chinese government. That is starting to pay off. This is a market that was down 50% since 2021. You have seen a very sharp turnaround in that market. That is carried over to other markets, thinking that, you know, China, who for so many years was the train pulling along the world economy for a while, that things will start to change in the Chinese market, and we will know more as we go on. But certainly this week, that was the big story there. The other big story is we had a very good number on the PCE, the personal consumption expenditure. It is the favorite measure of inflation of the Fed. It came in for the month of August at 0.1. That was what was expected, and that led to 2.2 over the last year, down from 2.3. The core is at 2.7. That is down. So that is moving in the right direction. What does that mean for the equity markets? That means that you are starting to factor in that the Fed will continue to cut rates. We saw the 50 basis points, as you've heard us here before. We didn't read much into 50 versus 25 because we know Jay Powell had told us that if he had had the information in July that he had in September, he would have cut 25 basis points then. So it was 25 plus the booster 25. Pretty much you can probably count on another 50 basis points between now and the end of the year. The Fed has another meeting on November 7th, a couple of days after the presidential election, and another meeting after that. So we would not be surprised to see cuts. The equity market is taking some solace from that. The bond markets this week, fairly docile. You saw the Treasury market up about 3 basis points across the board, 10 years at about a 377. The municipal market unchanged, the 10-year AAA is around a 263. Yield curve really didn't change much in either case, in either market this week. We talked about how the 2 to 10s has been unwinding and is now positive after, you know, being so many months negative. That tells you that Fed action is underway, and of course it is. One thing on the muni market, we're expecting to see a lot of supply in the next few weeks. That are municipalities front running the election, getting it out in front of the election, not wanting to face the volatility potentially of the election. And so that is softening up the muni market a little bit. We expect to see some pretty good buys in the next couple of weeks. And after that's ahead of us, behind us rather, then you could probably see a November with reduced supply because it's already been uploaded into October. So overall, a very good week, and we hope everybody is safe out there that was near the storm. And of course, if you have loved ones, we're wishing you the best of luck there, and we will see you next week. Thanks a lot.